I mean, unless you've been living under a rock, everybody's heard about a little stock called GameStop. And then there's Reddit, and there's Robinhood, and there's these millions of little investors kicking the hedge funds' asses. This is a wonderful time.
But you know, there's a big difference between the little guys who are buying silver and the little guys who are still buying GameStop or who still own GameStop. GameStop is going to crash. It's only a question of when. I mean, GameStop was overvalued, you know, when it was $10, $20 a share, and the shorts were jumping all over it. So now when you're talking about hundreds of dollars a share, it got as high as over $500 a share. This is not just the shorts covering. There are a lot of little investors who paid $300, $400 a share for GameStop. That stock could go to zero, I mean, or close to it. So a lot of people are going to get hurt.
Yeah, Peter, can you explain for those who do not know, what does buying, what about shorting GameStop? Can you explain the mechanisms in there?
Well, sure. You know, most people look at stocks and they think a stock is a good deal, and so they want to buy it, right? You think it's undervalued, you think the price is going to go up. Well, if you think a stock is expensive, if you think it's overvalued, well, obviously you don't want to buy it. But if you short it, meaning you sell it, you can profit from the stock's decline.
Yeah,
now,
so
the way you do that,
Peter,
right?
hang on. This is the part that drives people nuts about shorting. You sell a stock you don't own.
Right, but in order to do it, you borrow the shares from somebody who does own it.
Right.
So I go and I borrow somebody's stock, and then I take that stock and I sell it to somebody else who wants to buy it. Now, when the price drops, I can go into the market, buy it at that lower price, and then take the shares I borrowed and repay them. And the owner, you know, is no worse for wear. He gets his stock back. Of course, the stock has gone down, so he's losing, but he has the same shares. And so, you know, the only thing the borrower really has to do is pay the dividend. But if you short a stock that's not paying a dividend, well, then you don't have to pay that. And so you can profit. But the risk is that if the stock price starts to go up, your broker is going to mark you to the market, meaning that as the price of the stock's going up, on paper, you're losing money. And if the losses get to be high enough, the broker gives you a margin call. And hey, you got to deposit more money. Well, what if you don't want to deposit more money?
So Peter,
then you got to buy the stock.
Peter, you got to keep the math simple for me. So I go into some broker, I borrow, let's say, GameStop at $10. I borrow it. So that means I have to pay it back at $10. And I'm counting on the stock to go, GameStop to go to $5. But if the GameStop goes up, let's say from $10 to $100, that means I have to buy GameStop at $100 a share, and I just got wiped out. Is that correct?
Yeah, you've got to go into the market and pay 100 for something that you sold for 10. So you're losing 10 times what you got. But the problem is, if you don't have a big enough bankroll, depending on how heavily you shorted it, you may not have enough money, because as the stock is going up, you're having to mark it to the market. And now your losses, right? Just like when you buy a stock and it's going up, those are your gains on when you're short, that's a loss. You're seeing that loss in your account. And at some point, the losses the shorts can't take it anymore. And they're forced to buy the stock just to get rid of the losses, even though they know it's overpriced and they're confident that it's going to crash. They just can't take it anymore. And that's why it's a squeeze, right? You're squeezing these guys out of their shorts and you're forcing them to buy the stock at a much higher price than what they sold it for.
And so some of the Darth Vaders or the dark side with the hedge funds who are shorted, they've always just shorted stocks. They've made fortunes because nobody challenged them. And then comes along Reddit and Robinhood. And
well, that's not true, because short squeezes have been going on since the beginning.
Peter, I understand.
Yeah.
But never has such a mass come at them.
Yeah, this. Well, you know,
around 1400 with Napoleon. So it's been around for a while. But the thing is, I just want people to understand what we're talking about here. So the thing about buying, let's say GameStop at $10, the possibility is it could go up forever. Technically, not possibly, but that's what they're afraid of. And it keeps going up, and these Reddit and Robinhood and all these retail traders keep pounding on them. The hedge guys, their losses are approaching infinite. They have to pay money.
Well, in theory, you could say it can go up forever if nobody sells. But eventually, GameStop is going to sell, right? The company is going to create new shares and sell them into the market and take the cash. So there is going to be a seller. Even if all the Reddit raiders hold tight and they say, we're never going to sell, GameStop is going to sell. Right. And there has to be a buyer or the price is going to crash. My point is, we've been having short squeezes as long as we've had shorts. But yes, this is a very unique type of short squeeze. Nobody thought this was going to happen. Like Custer, didn't expect all those Indians, that little bighorn. But you know what? It's a risk. These are big boys. They have a lot of money. Murphy has a law, right? Anything that can go wrong will go wrong.